maybe to this argument about primary causes and factors. Clearly, one of the underlying factors, I think, was missed in this report. And I remember the London Economist, the British magazine, The Economist, making the argument in '02 that our Federal Reserve had set an interest rate that effectively was below zero if you included inflation into the calculation. Mark Zandi, in his book Financial Shock, and I see, Barney, you've had a quote in support of some of his conclusions, but I had a chance to have dinner with him and talk to him about this particular factor and how, in my view, and I think the view of many economists, the fact that for 4 years in a row you had interest rates which were below zero, and every time that has happened, and here's what the economists said at the time. They said, you're going to have asset bubbles in real estate, and because the Fed has done this in the United States, other central banks are going to follow. I just want it understood that when you eliminate or erase market discipline, as clearly we did with government intervention into the market, with the pressure to get those 20% down payments down to zero, Congress did that, with what we did with the GSEs, all of that helps create a bubble. And underlying that is this massive infusion of credit. And he goes through the argument, the extraordinarily easy money policies pursued by the globe's central banks helped pump up the U.S. credit and housing market. Now, as I read the report, yes, there's a mention on page 5. There's maybe 3 different mentions through the report about interest rates being low. But I think what you missed is something that the Federal Reserve and Mark Zandi, at least in the majority report here, the thing that you missed was the crucial role that played. And I wanted to ask you about that and how, and you've been criticized. I mean, this argument has been made by many journalists and economists since the report came out. I wanted to ask you about that. And the other point, I think, is that I don't think you can debate the issue with respect to the role of the GSEs given the losses, which are probably going to be $350 billion to the taxpayers, and given the fact that those institutions were at the heart of the collapse of the housing market. More importantly, the Federal Reserve came here in '04 and '05 and warned us that unless we regulated the GSEs for systemic risk and gave the regulator the ability to bring down those mortgage portfolios, that this would create a systemic financial crisis. And here we are. And so I wanted to ask you, Mr. Angelides, about those 2 points.
Great. Thank you very much. I appreciate the questions. First of all, we did look at international capital flows. We looked at excess liquidity. We looked at monetary policy. And in fact, in the book, I think it's on page 83, there's a whole section on credit expansion. We also have parts in the book where we discuss what happened in terms of other countries, housing bubbles. But let me say this. On that issue, the Commission concluded that yes, there was excess liquidity, but in and of itself, that need not have caused a crisis. That there could have been, recognizing that excess liquidity, regulators, market participants should have exercised discipline. And in particular, let me just give you the example of the Federal Reserve. Knowing that there was that kind of excess liquidity in the global economy, it was incumbent on the Federal Reserve to use its power under HOPA, use its power to set reasonable, prudent mortgage lending standards.
Okay.
And by the way, as someone who comes out of the real estate business, we should have recognized those asset bubbles. We should have had tighter mortgage lending standards. And I think that was at the heart. It was our failure to grapple with those capital flows. I think if we take the position that international capital flows are detrimental to this country, that's very damaging. We want to have capital flowing, and we want to put it to productive uses, not merely...
You cannot regulate, excuse me, but the idea that you're going to make money so cheap that it's less than zero, that for 4 years you're going to flood the market with that, and that somehow you're going to be able this is what economists would call the fatal conceit, that somehow you're going to be able to overcompensate for the fact that that much money is flooded into the market, and on top of it, you've erased market discipline by what you've done with government intervention with Fannie and Freddie and gone to zero down payment loans. The idea that some way, some regulator is going to be able to tamp all that down or keep that under control when the government has unleashed by bad decisions all of that liquidity into the market, I think is a fantastic belief. I can't understand in this day and age how people, unless you had central planning able to control every aspect of decisions made by people, how could you possibly undo the damage that those kinds of decisions create in an economy?
Well,
yes.
I'm sorry, I don't mean to interrupt you, sir.
But I think, even if we concede that some way you could overregulate for all of what's been unleashed, why not a real discussion on Fed policy in the majority report in terms of how this underlie the problem? And